So ladies and gents, it's now 10:30. It's the perfect time to start this morning's webinar. And this morning's webinar is entitled Concerned About Stealth, How to Improve Your Wealth, and it's hosted by AVC Wise. And what this webinar concentrates on is the changes to the autumn budget and also the ability that we all have to start thinking about fighting back against these stealth taxes. So let me introduce myself today so you know who's speaking. So my name is Greg March and I'm the Senior Retirement Education Specialist for AVC Wise. And I've got the pleasure of taking you through the next 25 minutes or so, explaining what you can do when it comes to fighting back against the tax increases that we've seen in recent weeks. Now, just before we get into the information, though, I need to give you some guidelines if you can. First and foremost, the content from today's webinar should be seen as educational purposes only. So please don't take anything I say as regulated financial advice. And during the webinar, we will be talking to you about taxation. So again, please be aware that the webinar is based on the current tax models and tax treatment can change and it will change again in the future. And when we speak about funds and fund performances, please be aware that these can fall as well as rise and any past performance should not be seen as a guide to any form or future performance. So what are we going to cover in the next 20-25 minutes or so? Well, the first thing I'm going to do is I'm going to give you a historical look at what's happened to our allowances, so the amounts of money that we can earn before we start paying tax, and we'll look at that on a historical basis. I'm also going to make you aware as well of exactly how much tax and national insurance that we pay today, because I think that when most people realise what we do pay, you'll start becoming more proactive in what you do to reduce those tax burdens. And I'm also going to talk about the mechanisms that you've got to reduce your tax going forward once you're aware of exactly what you're actually paying. Now, remember, questions, use the chat box, and I will come back to you at the end of the presentation. So the first thing I want to look at is we look at frozen allowances, because we've just seen the budget that's just come through. But previous to that, the government actually froze a lot of our allowances historically. And the first allowance that was frozen was the personal allowance. So you may or may not be aware, but the personal allowance is the amount of money that you and I can earn before we start paying tax. And in 2021, the government froze this allowance and they said it'll be frozen of £12,570. So we can earn £12,570. But that allowance will be frozen until 2026. And we'll come back to that in just a moment. Also, at the same time, the government also froze the amount of money that we can earn before we start paying tax at a higher rate. So when we're looking at taxation for anything above £50,270, we pay tax at a rate of 40%. And again, that was frozen in 2021 by the government. And they said, again, until 2026, when it will be reviewed going forward. At the same time, the government also froze what we call the personal lifetime allowance, or the pension, lifetime allowance. And this is the amount of money that we can have in our pension pot, a cash equivalent value, when we start drawing the benefits. And this was frozen again until 2026 by our government. So the most amount of money that we can have in pensions up until that point will be just in excess of £1 million. Now, for most people, that's never going to be a problem. But believe you me, for one or two of you in the audience today, that could be an issue. But that allowance again was frozen until 2026. So technically it means that as we go forward, we're actually starting to pay more tax on pensions if we exceed that amount. Another allowances that were frozen by the government, the capital gains allowance. So this is the amount of money that you and I can actually benefit from when we have things like shares and we sell shares. That allowance of £12,300 was frozen in 2021. And also ISA allowances, so the amount of money that we can put into tax-free environments in the high street, that's been frozen since 2017. And that's been frozen at a level of £20,000. And one of the worst taxes out there, the tax on death, inheritance tax, the government froze this allowance in 2009, where it was £325,000, and that's been frozen again until 2026. So before the budget, all of these allowances were frozen until 2026, which technically means that for the majority of us, if we do have any savings or investments, we're paying more tax. And for all of us, when it comes to our income for our employer, because the personal allowance has been frozen, ultimately we all pay more tax as well. Now, in the autumn budget statement, things were changed again. And this is what the government first and foremost told us. They said from those previous frozen allowances, we're now going to make some further changes. And the first change came to capital gains tax. So the amount of money that you can earn when you sell shares, or even if you've got a second property and you sell that, the amount of money that you can earn before you pay tax, that allowance has now been reduced. And as I've just mentioned, in 2021, the government froze that allowance to 12,300. So if you were to sell a second property, the first 12,300 would be tax-free, and anything above that would end up paying tax. But under the stealth mechanisms that we're currently seeing, the government has just announced that that's going to decrease to just £6,000. So if you sell shares, second property, next year you can only earn £6,000 before you have to start to pay tax. And this gets even worse, because in 2024, that's been reduced to just £3,000. So you can see at the stroke of a pen, if you are saving for your own future, be it through property, be it through shares, the amount of money that you can earn before you start paying taxes has been reduced from 12,300 to just £3,000 next year. That's going to cause a lot of issues for a lot of people. And one of the other allowances that they've reduced as well is the dividends tax allowance. So if you're holding shares in any environment outside of a tax-free environment, such as an ISA or even a pension, then if we receive dividends, we were allowed to receive £2,000 worth of dividends up until 2022 before we started to pay tax. But again, in the budget that's just come through, the government's now reduced that to just £1,000 from April 2023. And it's even reduced again further in April 24 to just £500. Now, there's a lot of people that do rely upon dividends, especially pensioners in retirement, to fund their lifestyle. But what they're going to find now is that reduction in the allowances means that ultimately they will all be paying more tax. So it's important that we understand what's happening going forward. And the other thing you also need to be aware of in the budget, the things that are going to impact most of us, is the following. Is that the inheritance threshold that the government said was going to be frozen until 2026. Now, remember, this has been frozen since 2009. They're going to freeze it again until 2028. So if you're expecting an inheritance, if your estate excluding property is worth more than $325,000, there's a hefty tax bill coming your way. Also, what they've done as well in the recent budget is that the threshold for higher rate tax has been frozen again until 2028. Now, what does this mean to all of you in the audience today? Well, simplistically, this means that more people will start paying tax at 40% than ever before. And the personal allowance, the amount of money that you can earn from your income before you start paying tax, again has been frozen from 2026 to 2028. So what does that mean to everyone? Well, simplistically, it means that going forward, more of us will become taxpayers than ever before. And what you've also got to understand as well is that these have been frozen until 2028. It doesn't mean that the government will then start increasing allowances in 2028. It just means at this point, the government will review these allowances again. So under the process of the recent budget that we've got, what we've seen is that our taxes are actually being increased through a stealth mechanism. So rather than the government saying that we're going to increase tax from 20% to 23%, 24%, what the government is doing it via the back door. And all I would say to you is if you're aware of this, then you should fight back, because ultimately you have the vehicle to fight back. I'm going to explain how that works for you in just a moment. One of the things that we need to understand as well is that when we start talking about taxation, a lot of us don't truly understand how much tax that we pay, because cleverly tax has been broken down to two mechanisms. We've got income tax and we've also got national insurance, but ultimately combined, they're both taxes. So let me just explain how we as individuals pay tax. Now, currently, remember, this is your personal allowance, frozen at least until 2028. So we can earn £12,570 before we start to pay tax. But for any income above that, we pay tax at a prevailing rate. Now, as a basic rate taxpayer, so if you've got income below 50,270, for any income above the 12,570 to 50,270, you will pay tax at a rate of 20%. If you're lucky enough to have income in excess of £50,270, you'll start paying tax at 40%. And also some of you may notice as well that this used to be up to a threshold of 150,000. But again, in the budget, the government's dropped this threshold down to £125,140. And for those people that have income in excess of that, then they'll start paying tax at a rate of 45%. So it's important that you understand how tax works, because if you know exactly what you're paying, then we can then start taking that back. And I'll show you how to do that in just a moment. Now, remember, in addition to income tax, we pay national insurance. And national insurance is just another form of taxation. But a lot of people don't really understand how much national insurance we pay. So let me again show you. We have the same allowance for national insurance, which is now £12,570. So when the government said we're freezing the personal allowance, cleverly, what it's actually doing is mean that we're all going to pay more tax via the income tax mechanism, but also we'll start paying more national insurance as well. Because if this allowance isn't increasing, because of things like pay rises, we end up paying more national insurance. So for anything over 12,570, we all pay national insurance at a rate of 12%. And that's the standard rate of national insurance. And again, that's to our income to £50,270. And if you've got income above that, the rate of national insurance for income above that level drops to 2%. But remember, you only pay 2% national insurance on any salary you've got in excess of £50,270. So that's tax and that's national insurance. But let me just explain this to you if we can. If we actually calculate then the full amount of tax and national insurance that we pay on our income in excess of £12,570, it actually means that all of you in the audience today, if you're a basic rate taxpayer, for every single pound above 12,570 that you receive, you give back to the government approximately 1/3 of that in taxes. So if you're receiving £100 above the 12,570, roughly 1/3 of it, just £32, you give back to the government in taxation. Now remember, as we progress through the tax years, this is actually going to get worse in real terms for ourselves. And if you're a high rate taxpayer for any income in excess of that 50,270, you're giving back in excess of 40% of your income to the government in taxation. So when we say how much tax do you pay, we don't pay 20% tax, we pay 32% tax. And if you're a high rate taxpayer, potentially that's going to be 42%. So that's a lot of your wealth that you're losing via the tax mechanism. So all I would say to you today, excuse me, is if you know how much tax you pay, start to become proactive and start to get that money back, because you've got the right tools available for you in order to do so. So when we look at the budget, just be aware there have been some major changes that will impact every single one of you today. So let me kind of go back to that personal allowance if I can. So the government originally froze the personal allowance until 2026, but they've just extended it with a stroke of a pen until 2028. So this means that the amount of money that we've been able to earn since 2021 has been stuck at £12,570. So going forward, if our income stays the same, or if we're lucky enough to get a pay rise, because of that frozen allowance, every single one of you in this room today will by default be paying a lot more tax, purely because of the frozen personal allowance. So what I'm going to ask you to do is just have a look at that and just ask yourself the question, are you happy with paying that additional tax rate? Now, some people will be, some people will think, well, actually, I'd like to start getting that money back. And this is where you can, if you decide to, fight back and start retrieving some of that extra tax that we're having to pay. And the best way in which you can do that is by using the mechanisms available for you via the local government itself. And the local government give you access to your shared cost AVC. And what the shared cost AVC allows you to do, rather than paying extra taxes to the government, is put extra funds away for your retirement future. So by making a contribution to your shared cost AVC, what you're going to do is actually receive tax and national insurance credit from the government, which ultimately is going to reduce the tax burden that you've got going forward. So on one hand, you could pay the extra tax and national insurance to the government and just allow that to occur. Or on the other hand, you could be proactive and start to plan and use your shared cost AVC as a vehicle to actually reduce your taxes because of the mechanism on how the salary sacrifice arrangement works. So your options are pay the government, or cleverly start to build retirement wealth by reducing your tax burden today. And this is where that choice really becomes apparent for yourself. So when you're questioning the AVC, by using the salary sacrifice mechanism, you're reducing the tax burden on your salary today. You're improving your wealth for retirement tomorrow. And as a majority of you are probably aware, then if you then draw this pension pot at the point in which you retire, you have the ability to access it as a tax-free lump sum for the majority of us. So pay the government or pay yourself going forward. And this is where we have to start understanding how things work. So by using the shared cost AVC, for every £100 that you put away towards your retirement wealth, it's only going to cost you the equivalent of £68. So what this simply means is that the government will only be taxing you going forward on the equivalent of £68 rather than the £100 you've got today. So when you're questioning the ability to plan going forward, and using the mechanism, the salary sacrifice share cost AVC, that ultimately will reduce these stealth taxes, let's think of the pros and cons that are available for us. So on one side, by being proactive, we can actually reduce our tax burden on a personal basis today by using the share cost AVC. At the same point, at the same time, what we're doing is by reducing that tax burden today by using the AVC, we're actually improving our wealth going forward because we're building an additional pot that we can utilize at the point in which we retire. And it also is going to give you a better retirement as well. So if we're proactive and do something today to reduce that tax burden, by default, we can improve our wealth going forward. Now, what's the negative to the salary sacrifice share cost AVC? Well, personally, the only thing that I can think about is the fact that these funds are tied up until a minimum age of 55. And I can't think of any other negatives that are there. So this is where you all have a choice today. And that choice is a personal choice for yourself. But we are in the mechanisms of an environment where tax is increased by stealth. You have the choice now. You can just accept what's happening, or you can fight back. And that's where I would like to sit. Fight back by using the products that are available for you that by default will reduce your tax burden, but also improve your wealth going forward. The choice is simply yours. So how do we fight back? How do we apply for the AVC if we haven't already got one? Well, very simplistically, to apply for a salary sacrifice share cost AVC, just go onto the ABC Wise website, so abcwise.co.uk, click on your account, click on new, and then just complete the details. And you'll start benefiting from the reduced tax and national insurance in the next payroll. If you're already a member of the share cost AVC and you now think it's time for you to improve your retirement future, increase that amount that you're putting away to reduce your current tax burden and beat the government, then simply go into your account and click on amend. It's as simple as that. Now, for some of you, if you'd like a little bit more support, we do offer the option for what we call a 20-minute Teams call. And the purpose of this Teams call is that we can give you a little bit more guidance, a little bit more knowledge on how the AVC can improve your wealth going forward. What we would ask you to do, though, if you don't mind, if you want one of those Teams calls, is be prepared to have a copy of your pension statement and also your payslip, because that will assist us in calculating the figures for you. But the purpose of that Teams call is to give you the extra guidance and knowledge that you're going to need to establish your AVC. Unfortunately, what we can't do with those calls is give you any form of regulated financial advice. So again, it's purely educational purposes only. And if you wish to go and get a Teams call, simply go onto the website that you can see on the screen, and you'll see all this website and that PDF document I've put in the chat box as well for all of you. So click on to the web address, so abcwise.co.uk/meeting, and book a Teams call, and then we'll get someone to talk to you about your personal situation. And then just before I go across to the questions section, let me just show you how you can contact us in other ways. So if you want just a general chat to us, then feel free to pick up the phone and give us a call, or use the live chat function that you've got on the website as well. And if you want more information just regarding how does my local government pension work, then again, use the website that's on the screen. So I'm just going to have a look at any questions that have come through so that we can answer those questions for you. So Christine says, is it possible that any change in the future could mean that the lump sum on retirement might become taxable? Christine, there's never say never when it comes to what the government is currently doing. But what I would say to you is this, is that when the government does change things in relationship to things like pensions, they give us forewarning, and we've not heard anything so far. But under the current rules and regulations, when you come to retire, you're allowed to access your AVC, taken at the same time as your main LGPS pension scheme as a tax-free lump sum. There are limits that are applied, but for the majority of people, that won't be an issue. Got a question just coming from Gary. He says, current savings rates are relatively high at the moment. Is it better to save any spare cash, or should I focus putting that into the AVC? Well, Gary, I can't give you financial advice, but what I would say is this. If you want to put £100 into a bank account that's giving you a return of 5%, remember that when you earn that £100, the government's going to be taxing you at 20% tax and 12% national insurance. So they're actually taking 32% off that £100 before you receive it. So if you were then to transfer that to a saving account, you've only got around about £66, £67 that you can use for savings. I personally believe that none of us save enough for retirement. And when you've got an environment where if you were to put £100 into the AVC, it only costs you the equivalent of £68, I'd use that as a starting point. But you need to get the right balance. You need money that's accessible, but you also need money for retirement as well. So without answering the question by giving you financial advice, £100 in a saving account, you're going to be taxed at 32% even before you receive the £100. You want to put the £100 into the AVC, it's only going to cost you the equivalent of 68. So you need to make up your own mind on that one. Tim said, is it only possible to access your AVC pot once you've retired, or can it be taken at or after 55 and carry on working fully or at reduced hours? So Tim, good question. There is the ability to access your AVC on its own. So if you were 55 today, you could request to access your AVC. But if you take that before your main local government pension scheme, then only 25% of the AVC will be tax-free and the balance potentially will be taxable. But there are mechanisms and strategies that you can look at. If you wish to take your local government early, because you have the right to, and then take your AVC at the same time, then again, that's where it's possible that you could access the whole of your AVC as a tax-free lump sum. The ability to take pension and continue working for the local government isn't a guarantee, though. You have to request it from the local government. So if you wish to take your pension and stay working for the LGPS, you have to request something called flexible retirement. And flexible retirement is at the discretion of your employer. So there are a couple of things there, Gary, Tim, that you need to consider. So Mel's come through, says, what happens if you're a part-time earner and you're near the personal allowance? So Mel, as long as you're a taxpayer, once you've paid your LGPS pension contribution, then there's always a benefit when it comes to the AVC. If you're not sure of what that benefit is for yourself, Mel, just request a one-to-one meeting via Teams. So just send us an email and we'll arrange for someone to speak to you and look at your figures on a personal basis. And Mary asked a question that says, is it worth joining the AVC if you're 59? Will I save enough money? Well, the reality is, Mary, is that if you join the AVC, it doesn't matter what age, we get people that join the AVC just a couple of months away from actual retirement. If you think of it logically, that for every £100 that you put into a scheme, as a basic rate taxpayer, that costs you just the equivalent of £68. And then if you were to access it at the same time as your main pension, take it as a lump sum, why wouldn't you join the AVC? So irrespective of time, every contribution will give you that benefit that works for you. So whether you've got a month to go before you retire, and you've got a couple of years, 15, 20 years, each contribution is a fantastic opportunity for you to save on tax and national insurance and therefore increase the growth on that contribution that you make. So remember, £68 today will give you £100 worth of lump sum if you take it at the same time as your main scheme tomorrow. So it's a good option. And Magda says, is the money that we invest into the AVC safe? Well, Magda, it can be, because when you go into the AVC, depending on what provider you've got, there are deposit-based funds, so cash-based funds. So cash-based funds don't fluctuate like the stock market. They don't give you the growth potential, but at least you know your money is there. And PM says, can we take all the money as an AVC as a tax-free lump sum? So again, PM, you can if you take it at the same time as your main local government pension scheme. Now, there is a calculation that's done in the background to work out exactly how much you can have in the AVC. but for most people, that will not be an issue. So to answer your question, yes, it is possible that the whole of the AVC could be taken as a tax-free lump sum. Now, they're all the questions that have come through so far. So let me just summarize today's webinar if I can. We are in a situation where we are, unfortunately, all of us being taxed more and more and more as we progress. The current thresholds have been frozen until 2028. That doesn't mean in 2028 the government won't freeze these again as they've already done previously. So by default, if we do nothing, you will see the tax burden in real terms increase. Why not be wise? Why not use your AVC as a vehicle that's going to reverse that burden for yourself? Use the AVC to put a little bit of money away for your retirement future, drop your tax bill today, but build up your wealth for when you do decide to retire. I can't think of any other negatives, can you? So thank you very much for your time and attention today. Hopefully you found the webinar of use, and we'll speak again soon. Thanks ever so much and take care. Bye-bye.